Welcome to De-Risk Investing. This week, we're dissecting a semiconductor giant that's at the heart of the AI revolution, Micron Technology, ticker MU. The stock has had a monumental run, more than tripling off its lows. The big question for investors now is, what comes next? Is this a classic, volatile, cyclical swing that's simply enjoying its moment in the sun before the next downturn? Or has the AI tailwind fundamentally transformed it into a long-term growth compounder? The narrative is compelling, but the valuation models are flashing some serious warning signs.
They certainly are, Sarah, and that's the tension right at the open. The market price is sitting around $236 per share. But when you run traditional, backward-looking quantitative models, the numbers are shocking. Our EPS-based fair value model spits out a value of just $61. The free cash flow model is even more brutal, suggesting a value under $3. Now, before listeners hang up, let's be clear. The model is punishing the company for the sins of the past, the massive cash burn and negative earnings from the 2023 cyclical trough. The market, on the other hand, is pricing the stock for a perfect future, completely ignoring the rearview mirror and betting everything on the AI-driven memory supercycle. The disconnect is one of the widest I've ever seen.
That's a critical disconnect to frame. So let's add some context with the macro environment, which feels just as conflicted. We have reports that nearly a third of the U.S. economy by state GDP is either in or near a recession. Sectors like commercial real estate and housing are already contracting. This implies a potential slowdown in demand for PCs, smartphones, and traditional enterprise servers, Micron's bread-and-butter business. So how does the company navigate a potential slowdown in its core markets while simultaneously capitalizing on this explosive AI demand? Does the AI supercycle narrative have enough force to overpower a broader economic headwind?
That is the multi-billion-dollar question. Let's look at the engine room. Operationally, the turnaround has been stunning. Revenue is up nearly 50% year over year. And here is the number that matters: gross margins. They've rocketed from negative territory in 2023 to nearly 40% in the last fiscal year, which tells you their pricing power in high-demand chips is back with a vengeance. Now for the fuel. Operating cash flow is incredibly strong, hitting over $17 billion. But, and this is a big but, the balance sheet tells a different story. Total debt has more than doubled since 2022, now sitting above $15 billion. To put it in a metaphor, they've strapped an AI rocket to the ship, but it's still carrying a heavy anchor of debt from funding the last downturn. The red flag here isn't earnings quality, which has improved dramatically, but rather that debt load and some minor shareholder dilution. They're funding this growth spurt with debt, not just profits.
That debt anchor is a key risk. It brings up the question of quality. Micron is trading at a forward PE of around 18, which looks incredibly cheap next to a name like NVIDIA at 43. The skeptic's argument is that this isn't a valuation opportunity, it's a quality discount. Is the market right to assign a lower multiple to Micron, viewing it as a more capital-intensive, historically cyclical business compared to its fabless or foundry peers?
The data says it's a discount, but the quality's improving. That forward PE of 18 isn't just cheap against NVIDIA, it's less than half the multiple of AMD and Intel. Its EV to EBITDA ratio is also well below the peer average. So from a valuation standpoint, it's objectively inexpensive. Now let's turn to the chart, because the technicals are telling a very different story than the valuation models. I'll group these into clusters. First, the trend cluster is unequivocally bullish. The price is holding firmly above all its key moving averages and the Ichimoku cloud. The chart shape looks like a powerful stair-step advance that just survived a very sharp but very brief stress test. Second, the momentum cluster is also strong. The MACD remains in a bullish posture, and the RSI, after briefly touching overbought territory, pulled back to 70. In a strong uptrend, an RSI holding 70 is a sign of strength, not exhaustion. Finally, the volume cluster confirms it all. On-balance volume is trending higher with price, signaling accumulation. The consensus here is clear. The price action is that of a market leader, not a laggard.
Okay, so the fundamentals are improving, the debt is a concern, but the technical trend is undeniably strong.
This brings us to sentiment, where we see a fascinating divergence. On one hand, you have Wall Street analysts with over 80% rating the stock a buy or strong buy. On the other hand, the options market is screaming caution, with a put-to-call ratio of nearly 2-to-1. This is a classic rhetorical pivot. Who is right, the analysts selling the long-term growth story, or the traders betting real money on near-term risk and volatility?
It's a fantastic setup. Let's break down that positioning. First, the short interest is very low, under 2.5% of the float. This isn't a battleground stock for short sellers. They've mostly moved on. The real story is in the options market. That 1.97 put-call ratio shows significant demand for downside protection. But we have to look at the psychology of the strike prices. The largest concentration of put open interest is way down at the $130 strike. That's not a bet on a minor pullback. That's a disaster hedge. Conversely, the most significant open interest for calls is stacked up at the $285 strike. So the options market is telling us that while traders are nervous enough to buy protection against a severe drop, the bullish traders are targeting a significant move higher from here. They're betting on volatility with defined targets on both sides.
So let's bring it all together for the verdict. Micron appears to be a classic cyclical swing, successfully navigating a structural transformation into an AI-driven growth compounder. The market is still applying a historical cyclical discount to its valuation, but the powerful tailwind from high bandwidth memory for AI is rewriting the company's margin and growth profile. The bull thesis rests on this HBM demand driving sustained margin expansion and generating enough free cash flow to finally address the debt on its balance sheet, which would force a significant re-rating of the stock. The primary risk to this thesis is a severe macroeconomic downturn that craters its core business, or any execution stumbles in the HBM ramp-up that allows competitors to close the gap. For these reasons, our strategic verdict is to accumulate.
And here's how we would structure that trade. The upside target is that psychologically important $285 level, where we see that heavy call option interest. That's where the bulls are aiming. For risk management, the invalidation level is a weekly close below the recent pullback low, right around the $200 mark. We're choosing that level specifically because it represents the bottom of that recent sharp volatility. A break below it would signify that the buyers who aggressively stepped in have lost control, and the trend is likely broken for the near term. It provides a clear line in the sand for the current bullish structure. As always, this has been de-risk investing. The analysis provided is for informational purposes only and is not a recommendation to buy or sell any security. We'll see you next week.